Yeah, so great question. I feel like for us, when we think about downside protection, a big part of that is diversification. So we're shifting from looking at just multifamily to adding self storage and manufactured housing and possibly some industrial this year into the portfolio. I think that's a big part of downside protection. And so we have a fund that we're participating in that is a combination of self storage and manufactured housing.
Welcome to the Real Estate Pros Show, where we interview real estate investing professionals from coast to coast, as well as the service providers that serve the real estate investing industry. Our goal is simple: share what's working now to help you improve and scale your business to the next level and meet the pros that can help you get there. Real Estate Pros is powered by Investor Fuel, America's leader in helping real estate investors and professionals build the business you need to live the life you've always dreamed of. Let's start today's show. Property insurance for real estate investors doesn't have to be difficult, but it does need to be there to protect you when you need it. MyInvestorInsurance.com not only provides insurance at 15 to 30% cheaper than traditional agencies, it's built specifically for real estate investors like you. You can set up an account in about 2 minutes, get quotes on properties, turn on and turn off insurance for your fix and flip or rental properties in around 2 minutes without having to talk to anyone directly, all through our portal. There's no better way or faster way to make sure you've got the coverage you need to protect you, and no more lengthy policies either. Once you're set up, you're billed monthly and prorated by the day for however long your policy is active. It's powered by MSI, the third largest independent MGA, with 1.5 million customers and more than $1 billion in cumulative premiums written. Get set up today in about 2 minutes at myinvestorinsurance.com/fuel.
Hey folks, welcome back to the show. Today's guest, Param Baladandapani, is a radiologist turned real estate investor who turned a challenging career transition into an opportunity to gain financial freedom. Today, she's active in the multifamily space and has over 2,000 doors. She's also a mentor to physicians seeking financial and time freedom. Welcome to the show, Param.
Thank you for having me, Dylan.
Now, when we talk specifically about getting into the real estate space, oftentimes people are struggling to find which segment to start with because they've got so many options. How
Yeah.
did you select multifamily?
So I didn't start off with multifamily. I started off slow and steady. I say I started off with a small and mighty portfolio, and been investing in single family homes for a while before I accelerated. I was primarily in the stock market, like most professionals are. And then I had a career transition that you mentioned, and I realized that I was making 6 times more returns in my real estate portfolio compared to my stock portfolio, and I wanted to accelerate because it would take me 17 years to get to financial freedom going down the traditional path. And after going through that turmoil, I realized I never wanted to do that again. So I pivoted to real estate and I got aggressive about learning about tax strategies, short term rentals. And I've been paying $0 in taxes for the last few years. So right, the IRS tax code is very real estate investor friendly. That really boosts returns. So I scaled my portfolio, my direct ownership portfolio, and then went on to build the Generational Wealth MD community to help others do this because I was like screaming about it from the rooftops. And now we're like 20,000 strong. And the majority of people in the community don't want to own their own real estate, which is when I started pivoting to multifamily. That's when we built the GW Capital, the fund to help our community invest with us in vetted opportunities. And multifamily brings in that scale, allows us to do the value add creatively at this point, but really help those other investors to be passive, get that mailbox money, but still get double digit tax efficient returns. And so that was the reason for the pivot to multifamily. But again, I'm a strong believer that there are multiple different strategies. You pick what makes sense for you. This is just what makes sense for the community at this point.
One of the things that I've noticed that's challenging about, being a professional, whether it's high level attorney or someone in the medical field is you get to a certain point, you've got so much education, you're putting in so much time in, and you kind of have to decide, hey, am I going to stick to this or am I going to look for, an early retirement? Because you get to a certain point and it's like, hey, I've already put in this much time.
Yeah.
What's an extra, 5 years? Hey, this is where this is going to get me.
Yeah.
Do you feel like there's a lot of folks, especially maybe younger medical professionals right now, who are at that kind of inflection point where they have to decide, hey, am I going to ride this out into the sunset and this is what I'm going to be doing?
Yeah.
Or am I going to maybe look to make a pivot into a real estate investing or something similar?
Stop living on an island and join the #1 mastermind in America for professional real estate investors. Investor Fuel is a community of hundreds of the nation's top investors working together to build stronger businesses and better lives. In addition to the amazing community of real estate investors acting as a board of advisors for one another, Investor Fuel members have access to 100% funding on purchase and repairs for our members only, a health insurance program, and benefits and discounts that more than pays for the membership of most of our members, meaning it's actually costing you money to not be a member of Investor Fuel. If you're looking to scale your business and build a business that allows you to live the life of your dreams, please visit investorfuel.com today and book a call with our team.
Yeah, that's a great question. And it applies to most of us, right? So do I go down the path? Do I want to retire early? And I always talk about it as if you're someone who's investing, if you're making money in any way, right, you need to invest that capital. And when you're investing it, your bucket cannot be just stocks and bonds. You need to have alternative assets in there. So I feel all of us need to be investing in alternative assets like real estate. It should be at least 25 to 30% of all of our portfolios. So you're doing it simultaneously, right? You're making the money, trading your time for money, taking that and making each dollar work for you so that, and it makes work optional, right? There are physicians in our community who do invest in short-term rentals, multifamily. They make over $1 million in annual gross revenue from real estate, and they're still practicing full-time medicine, right? They just have options now because they've replaced their income. They're sheltering, and then because of real estate, now they're sheltering millions of dollars of their W-2 1099 income from taxes. And so it's almost like it's accelerating things, but it just gives them choices. Now you practice more intentionally, or you go to work and do what you want to and do what your passion is, whatever that may be. But you have options and you can walk away from all of this. And you're in the Dominican Republic. I travel to India 6 months of the year. We can do that and pick the lifestyle we want to live. And that's all I say. All it gives you is options. And anyone making a dollar by going into work and you're trading your time for money, you need to take that dollar and figure out how much of that you're saving and what you're investing in. And I don't think we can eliminate alternative investments because, the holy grail of investing is have diversification in your investment so that if the stock market crashes, you're invested in non-correlated inflation adjusted real assets. And that's the game, right? That's the game to win. So you're not working till you're 65 or working till you die. And that's just the way I like to look at it.
One of the things that you mentioned is being able to offset some of your W-2 tax burden, which I think gets overlooked quite a bit. And people might say, okay, well, how much money do I have to really be making in order for this to have a dent? I think oftentimes, I don't know how it was for you in the process. I didn't even think about saving money on my W-2 job until I left the W-2 world. And I realized, oh my goodness, I could have been,
I know,
getting so much money back, but really I just wasn't aware because I figured, I'm a W-2 employee. This is the taxes that I have to pay. Whether or not, you have the full understanding of the tax strategy involved, I think that there's a huge opportunity, especially for people in the medical field, to offset some of that tax burden.
Yeah. And I say this, and there are people who come and say, I work full time, so I don't know if I can tap into these tax strategies. Or they'll say, well, I don't know if I want to do short-term rentals, which is one of the ways someone who's working full time can get those tax savings against W-2 income. And I start off with this. No matter how you invest in real estate, we have investors who invest passively in our fund. They're completely passive. They're working as radiologists, and they're making six figures in cash flow, right, which gets deposited into their bank account every month. And that's completely tax-free, right? So even if you aren't getting aggressive and using these tax strategies to shelter your W-2 income from taxes, which you could do, but even without that, all of your cash flow from real estate, as long as you're using leveraged real estate, is inherently very tax efficient, right? And now, when you exit those opportunities, you have ways like with 1031s and lazy 1031s. The exit can be tax efficient also where you're not paying capital gain. So I feel like I want professionals to think about this as it's amazing if you can take it and have that. The cherry on the cake is when you can get the tax savings against your W-2 income. But those are a little more advanced strategies, and many of our doctors do it. But even if you didn't do it, even if you invested passively, your income and your wealth that you're building in real estate is inherently tax efficient as long as you're strategic about it, right? But full-time physicians, we have physicians who in our coaching program, they invest across the state, across the country, and they manage remotely because we help them build systems. And they're spending about 2 hours a week on their short-term rental portfolio, getting in those tax savings and building portfolios that are generating over $500,000 in gross revenue, right? So it's doable. It's completely doable, which is why we need to hear these stories, which is why podcasts like this are super helpful.
If you're looking for consistent, high quality leads, look no further than Investor Machine. Investor Machine isn't just another agency, it's the most sophisticated, data driven lead generation company on the planet for real estate investors, and serves the role of being not just a lead generator for your business, but a marketing partner that is helping you achieve your goals along the way. Go to investormachine.com to learn more and schedule a call with our team today.
But I always tell people, remember that even if you're not going down that path, and some people, like you are a real estate professional, you qualify as that. Some people have spouses or they work part time and they qualify as real estate professionals. And so they can take those losses against their W 2 income. So there are a few strategies there: medical office buildings, many strategies where people who practice medicine or work full time or part time jobs can still get the tax savings against their W 2 income. But even if you didn't do that and you invested passively, you're still super tax efficient in the income and the returns you're making in real estate.
One of the things that is particularly relevant about this conversation is, when you're talking about a medical professional, you're going to spend so much time in school. Then you have, your medical school. Then you've got residency, and then you've got the first couple years of your profession where you're, you know, getting into the on ramp of wealth building.
Yeah.
All this time, right? You're waiting for the money to be made. The money then starts coming in, but I've heard this term, Henry. I don't know if you've heard this
Mm.
term before. High earner, not rich yet, right?
Yeah.
And it's like, okay, well, now you have to be close to where you're working. You're getting your first home. Now you've got this debt. Now you've got the student loans, which are like, who knows how much, $500,000. So now you've got all
Yeah.
these obligations, and so you're looking at everything, going like, wow, yeah, I'm making all this money, but I also have all these obligations. And then so you start to realize, like, okay, well, how am I going to accelerate this? And people start coming to you and they might say, insurance or various different investment vehicles. But oftentimes, people start to realize, like, okay, the real way for me to build wealth is for me to be managing it, for me to be my own wealth manager instead of me allocating it to someone else. I think that's how a lot of people are getting interested in real estate.
Yeah, I mean, and so that's true. I remember I was 10 years out of all my training, and that's when we had my husband and I both, there was a merger at work. We both lost our positions. And I look back, I was like, we've been making, each close to $500,000 for 10 years. We should be in a good spot. And then there's lifestyle creep and there's taxes that you're paying. And it depends on what you're investing in. And I was primarily in the stock market and I had large fixed income allocations. And I realized it would take me 17 more years of doing that, even as a high income earner in a high income subspecialty, right? I have doctors who are traveling 2 hours each way to get to a job that they don't like and they feel limited. I mean, I live in Central Valley, California. And so, there are many situations where it's this arrival fallacy. You think you're making the doctor income, but you're not necessarily moving the needle as much as you think you are. And I always say, I have a free calculator that people can, if you go to generationalwealthmd.com, guys, this is what got me started. I put my numbers into the calculator. That's when I realized, well, 17 more years for me to get to financial freedom. There's a 4% rule. You can't withdraw more than that from your stock bond portfolio if you want it to last you 30 years. And I didn't know that. I was like, oh, 10%, I can withdraw 10% from my portfolio. That's not how it works. But real estate is a whole different ballgame, right? That cash flow, it's yours to keep. It's tax efficient while your wealth is growing. Your equity in the property is still increasing. Right? Very different ballgame. And I say, know your numbers. That's the best way to get started. But yeah, there is a arrival fallacy. Most of us are Henry, right? And we never, when the tax code changes and President Trump made all these changes, Henrys were the ones who got affected in the worst way possible, right? Everybody else, business owners and real estate investors, got the tax
Yeah.
breaks. So we need to start thinking smartly, and we can't just be employees. We need to like tap into that business person investor role, and that's where real estate comes in, where you can be super time efficient and you can still be building tax efficient wealth.
I'd like to pivot a bit here, Param, and ask you about acquisitions in the multifamily space. I'd say maybe now more so than ever. It's been an interesting couple of years to be a multifamily investor, syndicator, fund manager, and when you're seeing more and more people get into the space, you're also seeing a lot of people take out like variable rate debt, and you're seeing the cost of builds go up, and then you're seeing occupancy rates in certain markets fluctuate. I'm in Texas, so you would be shocked to see just the incentives that people are
Oh
putting
yeah.
out to get people to move into some of these apartments. Things like 2 months of free rent plus a $500 Amazon gift card. And so, how has it been for you navigating this space over the last couple of years?
If you're a new or newer real estate investor looking to launch or grow your real estate investing business, please check out Investor Fuel Club. It's a coaching community, but unlike anything you've ever seen before. And you can actually partner with members of our mastermind from coast to coast on deals right in your market. There's no better opportunity to build a consistent business than to literally partner with pros to help you avoid costly mistakes, avoid the need for capital to do deals, and help you eliminate your fears as you're starting your business. Learn more about Investor Fuel Club at investorfuel.com/club.
Yeah, and you're absolutely right, Dylan. It's a very different environment compared to where we were 2, 3 years ago, right? The way we're underwriting, the experiences we've had have all shaped us. And when we started GW Capital Fund One, our goal was to help our investors lower their risk. Like downside protection was a big part of it, and then the second part of it was how do we get them higher returns than retail investors. And the fundamentally the fundamentals haven't shifted, right? Multifamily is still residential real estate has strong fundamentals. We're still at a nationwide shortage, right? Affordability is at its lowest. It's in some parts of Texas, it's half as expensive to rent than it is to actually own, right? So the fundamentals exist, but the way we acquire has really been shaped by what we've seen in the market, right? So downside protection is more and more important. And I say when we think about downside protection, and this is true for all of us, right? We're all titrating. There are three really important things that we need to look at. One is the kind of properties we buy. And honestly, right now it's a great time to be buying discounted properties because we're seeing a lot of discounts. But to buy for cash flow, and this is for anyone listening, if you're trying to vet opportunities that you're going into, especially multifamily opportunities, it is still possible to buy properties that cash flow day one. And I'm not talking about properties that cash flow once certain aggressive assumptions come into play where, it's year two, we're going to have this. We like to, downside protection for us is going into assets that are cash flowing at 5 to 10% day one based on the last 12 months of income, right? And new expenses, because expenses go up when you acquire a property. So that's really important. And having a longer term horizon, I think where people have gotten burnt is having shorter debt terms because it doesn't give you time to weather out the market. So we're looking at 5, 7, 10-year acquisition hold timeframes. And so I think that's really important on the buy side. And many investors,
Yeah.
many operators have pivoted. And if you haven't, and if that's not something you're looking at, then that's key. The second piece is the hold piece. You really need to be able to hold on to these assets because the only people struggling are the people who aren't able to hold on to these assets, right? This is where debt comes into play. We haven't. We're very intentional about the kind of debt we in the assets we take on, and I still see some really sophisticated operators do variable rate debt. The truth is, if we're going into a pro-inflationary environment, we don't know where interest rates are going to land. The
Right.
safest thing is to take that variable out of the equation. Long-term fixed interest rate debt with agency is obviously the safest way to go. And then your ability to hold a deal also depends on how you stress test it. So very aggressive assumptions are definitely not something we want. We really don't know. And like you mentioned, rents have plateaued or even dropped in many markets, especially in the Sun Belt, right? The Midwest
Yeah.
market didn't get hit as much because supply has been, there was a lot of building happening when interest rates were super low. And a lot of that supply happened in those markets where the demographics were excellent, right? There's still a lot of migration happening. But in the short term, like you mentioned, rents are stalled, lots of concessions, and occupancies dropped. And so you really want to stress test those deals really well and make sure you have a strong buffer. That's going to be key in holding adequate reserves. But I feel like this is the best part, right? The third piece to the puzzle, right? Buying the right opportunities, having the ability to hold on to them, but controlling what you can control is what we do as operators, right? And in my experience over the last few years, the operators who've really come out and stood apart from the rest are those who can. This is not, and usually, typically, when we say control, the tax efficiencies are always there. Right? We're still getting those tax efficiencies. 100% bonus depreciation came back last year. So that's really helping investors. But the big piece of that puzzle is value add. And value add has shifted tremendously in the multifamily space over the last 2 years, right? A few years ago, value add was all about let's dump a ton of capital into these properties, rehab them, and bump up rents. No one's seeing the ROI that was projected in these properties anymore. It's hard to bump up rents. It's a very different environment. And what we've pivoted to, and any operator worth their salt is doing is it's creative value add, right? In some of our
Good.
assets, the value add. I mean, we're still bumping up NOI by 30 to 100% in some opportunities within the first year, but not by doing rehabs necessarily. Sometimes this is through property tax exemptions. We've done this in our Houston opportunities, partnering with the Houston Housing Authority, getting those property tax exemptions, dropping property taxes by 50%, 75% in year one, reducing expenses essentially, right? So that's been a big one. Sometimes we go in and in this, we just closed on a property last week. The business plan is reducing expenses by 500,000 in year one, right? That bumps up. Think about that at a five cap, that is increasing the property's value by millions of dollars. And we can execute that within the first 2 years because we have a property management team at a sister property, same submarket. We're just going to move them over. So we really know what expenses are. We really know what we can do with good marketing to bump up occupancy. But all of this is what I call creative value add, where it's not your traditional bread and butter rehab and bump up value. It's more how can we get creative about increasing the NOI, but not necessarily banking on income growth. I mean, especially not rent growth, right? Other income, there are ways we bump that up in, amenity fees, valet trash. There's so many ways to bump it up without being aggressive, where we know we can make it work. But I think the control piece is still there, which is what we love about real estate, right? It's not
Yeah,
something
yeah.
where it's not in your hands, but the way we think about control, I think, has shifted massively in the last few years. And every operator who's really been able to weather the storm has done that through creative value add, which is operational efficiencies and maybe property tax exemptions, or in the manufactured housing space, we've done it through increasing income in many other ways, utilities and building to add revenue. But it's been a world of creative value add because we haven't had the market tailwinds, and the only way to do this is to really cut costs and get creative. There's still a lot of control available, but and I would say for anyone listening, I think the easiest thing to do is to go ask operators how their acquisitions in 21 through 23 are doing, and then if they're still able to hold on to them, if they're operationally, if they have streamlined things, and I think that's really what's made the good operators stand out from the bad in the last few years.
Yeah. You mentioned the ability to not just look at it from what I think most people were traditionally looking at it like, hey, we're going to have a certain rent increase every year. We're going to add, a fountain and certain amenities, but also look
Yeah,
at it from the other side of the equation, which is what expenses do we have that we can reduce? And the
yeah,
tax strategy, that's actually the first time that I've heard that in
yeah,
any interview on this show, because I think most of the time, again, people are not looking at it from that side of the equation. They're
yeah,
really hyper focused pretty much exclusively on value add and things
yeah,
that they can do to increase rents, even in like a staircase scenario, like every couple of years, we're going to increase rents. Well, what
yeah,
happens when the reverse happens, when you have a downward staircase and people are now
yeah,
looking at, okay, well, if you're looking at increasing my rents, then I'm just going to move, right?
yeah,
Because this other apartment complex is offering incentives and lower rent.
yeah,
I'm not married to staying here, right? So
yeah.
I think everything that you mentioned about the expense side is a huge, nugget for our audience here. We are coming up on time here though, Param. Any new projects that you're working on? And then as well, what's the best way for folks to get in contact with you or your team?
Yeah, so great question. I feel like for us, when we think about downside protection, a big part of that is diversification. So we're shifting from looking at just multifamily to adding self storage and manufactured housing and possibly some industrial this year into the portfolio. I think that's a big part of downside protection. And so we have a fund that we're participating in that is a combination of self storage and manufactured housing. The returns have been excellent. And some of those assets were bumping up NOI by, like I said, 40, 100% in the first year of acquisition, and just creatively value adding, right? And so if anyone's interested, I'd say go to gwcapital.com, capital with an A. And we have a priority investor list. That's a great way to get notified about our upcoming opportunities. You get to be part of the webinars. A big focus for us is education, because I feel like my job is to equip everyone to do their own due diligence. And then, when you come in, that obviously there's the no like trust factor, but I want everyone to know and understand what they're getting into, so you can really personalize your investing based on your risk and goals. And so gwcapital.com is probably the best way to get notified about future opportunities. And we definitely have within the next month, or I don't know when this is airing, but we'll have webinars on a monthly basis where we talk about new opportunities. And then then for anyone really thinking about direct ownership and short-term rentals and really, owning and controlling their own properties, or getting real estate professional status, generationalwealthmd.com is our site. And I have a free ebook where I talk about my journey and how in 1 year I accelerated to financial freedom through some of these creative strategies. And it actually has all the numbers there, and it'll just get you thinking. And I think that's a good way to get started.
Thanks for joining us for today's Real Estate Pros Show. You can learn more about the amazing benefits of the Investor Fuel Mastermind community, including surrounding yourself with hundreds of other rock stars, 100% financing for your deals, and members-only discounts from vendors you're likely already using that, as a member of Investor Fuel, will save you more than the cost of your membership. Visit investorfuel.com to learn more. If you're interested in joining us as a guest of this show, please visit investorfuel.com/pros to apply. You can also check the show notes for access to free resources, how to get access to world-class lead generation, and much more. Don't forget to subscribe so you never miss another episode. Have a great day. We'll see you on the next show.